saw a little earlier, a very bullish start to the share market for Australia, so things looking on the up, albeit perhaps the budget surplus now in a bit of danger, and of course coming off some very weak economic growth last year. So how are things looking for the coming decade in an economic sense for Australia? Well, KPMG says it's instructive to look back on the past 2 decades to get an indication on just what we have coming for us. Rynne joins us now, the KPMG Chief Economist. Brendan, thanks for your time. So you've been looking back at the past couple of decades. Interesting to see that in terms of annual growth hitting 5%, you know, this sort of bump a year, it has happened 3 times in the last time in the noughties it hit, but only once since 2012. So this feeling of stagnation, it's real.
Absolutely, and we're seeing overall economic growth just having a much lower trajectory going forward. However, in saying that, I think you also pointed out that we reached 5%, say 3 times during those past 2 decades. So in fact, our growth profile during that time period was much more volatile than what we're seeing here now. So while the absolute growth rates are lower, growth is more stable, albeit just at lower rates than what we're used to seeing.
I guess the big concern is that last year I was referring to only just beating the time after the global financial crisis. How much of a concern is that? Does it feel like that year's sort of behind us and rosier future awaits?
Look, I think it is. I think what the issue now is how have the Australian economy and other economies around the world changed as a consequence, and what's been the structural impacts of that change and how that impacts growth going forward. Now in Australia, for example, we're seeing consumption growth being much shallower than it used to be in the past. That's due to a number of factors, including much more subdued wages growth, level of household debt that's much higher than we've seen in the past, and more recently we've seen a knockdown in our wealth as a consequence of house prices falling, and now they're starting to recover a little. But overall, we're seeing consumption growth around the 1 to 2%, when historically we were seeing it, you know, above 3%, and that was very much driving GDP growth as a consequence.
In terms of how we're prepared, we've heard a lot about reports from education, certainly at primary and high school, that things are not going well. Another concern might be research and development spending. Innovation spending is okay, but R&D, not so much. What's happening here? Is this just not exciting enough for headlines? I mean, Malcolm Turnbull trotted out his policy, but it seemed to just be abandoned at the side of the road soon afterwards.
Well, look, I think the issue with R&D expenditure is that it's often, you know, highly risky, highly volatile, and businesses need to be usually in a large degree of profit for them to be able to want to spend that R&D at that point in time. So what we've seen is that R&D and intellectual property spending have increased within Australia, but it's increased as every other business expenditure's increased as well. So when we still compare ourselves at an international level, we're far off the pace. And if we're wanting to be a knowledge nation, leading innovation, then that's certainly one area of policy reform and improvement that not only federal government but state governments really should be looking to improve as well.
All right, well, there's a message for any politicians watching. I wanted to ask you as well about this warning that KPMG has effectively for quantitative easing. This would be the next step from the Reserve Bank beyond lowering interest rates, sometimes referred to just simply as printing money. I get that's a simplification.
Yes.
But the warning here is about whether or not, I suppose I'd put it this way, whether or not the sort of Darwinism of companies is no longer allowed to happen. You call it this zombie companies that are debt-ridden. They're not dying off, but they're not doing anything. And perhaps it's better when some of these companies do go by the wayside.
And that's exactly right. So what we did was have a look at those countries that have adopted quantitative easing over the last few years, including the US, Switzerland, Japan. And what we did was have a look at the size of each of those relative countries' central bank's balance sheet against GDP, and then looked at that in terms of labour productivity for each of those jurisdictions. Now, what we found was while the effect on labour productivity was relatively small, it was statistically significant. So what that did show was that as countries' balance sheets expand as a consequence of quantitative easing, productivity within those countries also started to fall away. Now, the hypothesis around that is that businesses that otherwise would have died have now got access to funds and capital more so than they would have had before. When a company dies, we know that those capital and labour that that company has can get redirected into more productive uses within the economy. But if they're being kept on life support because of cheap money, you're not getting that creative destruction benefit that usually you've seen in a normal functioning financial market. So that's one of our...
I guess they might die off, they might get taken over, whatever it is, they're not left to sort of stagger on. So that's the warning, I guess, on QE.
That's right, and they're not...
I just wanted to ask you... Yeah, so we're nearly out of time. I just wanted to ask you about this, though. The prognostication for the next 10 years, you think will sort of go along at steady, if unspectacular growth. But within the employment sector, you're tipping more jobs towards the services sector. What trend are you talking about here?
So Australia's already a services economy. About 3/4 of our people are employed within the services sector, and that growth is continuing. What we're seeing is a movement down from employment within the secondary sector, which comprises both the manufacturing and some construction activity work, into the services sector. And so that effect of moving from one part of the economy into another comes with it a whole range of issues that policymakers need to consider. Certainly there are some parts of the services sector that are high value adding, like professional services, the financial sector, but there are also other parts that are relatively low value adding. The accommodation and retail services, for example, don't contribute anywhere near as much as a job at a bank does, for example. And so as we have this shift of employment, it's going to be really important to understand and promote growth to those higher value-adding services industries as opposed to seeing everyone become baristas.
Indeed, Brendan Rynne, fascinating insights into what might be for the decade ahead. Thank you for your time.